This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant ratings service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Into the breach, Target confirms personal identification numbers were stolen in this month's theft, but says the data is safe. Others say they're not so sure.
Shredded tweet. Shares of Twitter get slammed today, and that will likely deepen the divide on Wall Street. Do you buy this high flyer or not?
And finding quality. Our market monitor says he has quality names you should own in a world of record highs on Wall Street. We have all that and more for this Friday, December 27th, 2013.
Good evening, everybody, and welcome. Target now confirms that debit card PIN data was stolen in that massive security breach affecting 40 million customers that began last month. Now, that is a backtrack from Target's earlier claims this week, but the retailer says the PIN information is, quote, safe and secure because it's encrypted. That news only turned up the volume on an industry debate over just how safe your personal data really are. Dominic Chu has more.
Today, Target said debit card PINs remain, quote, safe and secure because the decryption key, a code needed to crack its encryption process, is held by its payment processor and is not stored in any of its own systems.
It would probably take decades for each one of those to be cracked, and it's just not worth the criminals' time. They don't have enough computing power, and even if they did, it would just, the return of investment is abysmal.
Some experts believe today's news should provide a measure of relief for Target customers who've been watching their accounts for signs of suspicious activity. Others are not so sure.
Target may be understating what's going on here because based on history, we have seen PINs decrypted and cash withdrawals as a result.
Mark Rogers of mobile security vendor Lookout takes it a step further, saying, quote, in my world, there is no such thing as permanent secured encryption. I do think people should change their PINs as a precaution. Damage control is the order of the day, both for consumers wondering who's got their information and for Target as it seeks to win back the trust of shoppers. For Nightly Business Report, I'm Dominic Chu.
On Wall Street, stocks ended the day in the red, but they were up for the week. But investors were more focused on the action in the bond market. The yield on the benchmark 10-year Treasury topped 3%. It's the first time in 2 years that Treasury yields reached that psychological level. And strategists are mixed on whether higher rates will threaten the bull market in stocks. But here are the closing numbers for Wall Street today. The Dow lost 1 point, the Nasdaq was down 10, and the S&P was off a fraction. Over in the oil market, crude prices closed over $100 a barrel due to a drop in inventories. This is the first time since October that oil closed above the $100 level.
Shares of Twitter got the tweet kicked out of them today. They fell 13% after Macquarie Research cut its rating to sell, saying the stock has rallied for no apparent reason, and rally it certainly has, nearly tripling since its IPO back on November 7th. Not bad for a company that is yet to show a profit. But today's move won't quiet the debate on Wall Street over this stock.
What's clear is that Twitter is a social media darling. What's not clear is why investors seem to love it as much as the tweeters do. Up 7% Monday, another 5% Thursday, up 76% this month through yesterday, when it closed above $73 a share. But not everyone is so smitten.
When I look at a Twitter, I think, who in God's name is willing to buy this thing?
By any ordinary stretch of rational mathematical thinking, this valuation doesn't make sense.
We don't see earnings until 2015.
One buyer is Neil Doshi of CRT Capital Group.
This is the fastest growing internet stock out there.
The buyers see a future loaded with ad revenue, especially video commercials targeted to Twitter users based on their web browsing histories.
You're going to see operating margins grow from low single digits today to 20, 30, 40, 50%.
When? Possibly the second half of next year, he says. But others warn this is one stock that's come way too far, too fast, worth more now than Target or Time Warner Cable.
It seems like now we're approaching some type of mania. It's definitely vulnerable to a crash. I'll let somebody else trade it. I won't.
And take a look at Twitter. That's its action today. It was down 13% to 63.75 after closing above 70 just yesterday.
Also in the spotlight today, the so-called Volcker rule. Small banks have complained that one of the rule's requirements means they have to get rid of some debt investments, and that could result in big losses. The American Bankers Association is suing government agencies over that provision. Federal regulators are reviewing it and will decide whether to change the requirements by January 15th.
If you're trying to get a mortgage in 2014, you may find it's harder. The reason is that new rules go in effect in January. The need for almost perfect credit is one reason the housing market is only slowly recovering from its recessionary bust. But now, as Diana Olick reports, lenders will be asking for even more information.
During the last housing boom, lending standards went out the window, and we all know how that turned out. So Congress passed a law requiring lenders to make sure borrowers could pay their loans. They directed the Consumer Financial Protection Bureau to create rules to help ensure that. The rules are not mandatory, but if a lender follows them, they have made a so-called qualified mortgage and get legal protections should the loan go bad.
The biggest change for the average borrower is going to be just increased documentation.
But borrowers will also be limited by the new rules, which ban riskier products like interest-only loans. The lender must verify income and assets and not charge excessive fees, and the borrower cannot spend more than 43% of their income on debt. That last one will knock a lot of borrowers out, especially those who might actually be quite wealthy outside of their income. That's where some lenders will choose to operate outside the new rules.
Looks like a nice niche from a lender's perspective because you're not going to have as much competition. Certainly you're going to have a much more regulatory risk.
That's why those who are choosing to operate outside QM, like Wells Fargo and Bank of the West, say they will only do so for the very best candidates.
We're going to apply a very strict table of qualifications to ensure that there's additional income as well as additional assets to be able to support the case that these borrowers did in fact have the ability to repay when we made them the loan.
In other words, wealthy borrowers who just happen to be driving the housing market right now because lending is so tight. The average loan size today is at an all-time high, almost $270,000, because less affluent, less credit-worthy borrowers can't get a loan, or at least a loan they can afford.
The buyers that are out there are much more affluent. They have much larger home savings and home equity saved up, and they're looking for a larger type of house. And the first-time buyer, unfortunately, remains pretty well locked out of the market.
The rules won't make it any easier for first-time buyers to get a loan, but as the rules settle in and lenders get more comfortable operating outside of them, that may change. Some lenders may be willing to take on those borrowers and the risk that goes along with them. Of course, they'll charge a hefty fee to do it. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about the new mortgage rules, head to our website at nbr.com.
A midnight deadline coming up tonight for some Americans receiving unemployment benefits. An estimated 1.3 million people who've been out of work longer than 6 months will stop getting federal unemployment benefits tomorrow. The 2008 program, which continued the benefits for as much as 99 weeks, has been extended 11 times, but it was dropped as part of the 2-year bipartisan budget compromise that was just signed into law by President Obama. And John Harwood joins us now here on our set. Thank you so much, John, for coming in. This has been such a Democratic issue. Why did they let it go?
Well, I think there's been a psychological turn in Washington, and that is from thinking about the economy as one that is in crisis and then recovery from crisis to one that is growing, the labor market is strengthening. Democrats are still for the extension of this program. The president today called 2 senators, a Republican, Dean Heller, a Democrat, Jack Reed, and encouraged their effort for a 3-month extension. But you don't get the sense that there is going to be a final push across the finish line by Democrats, and that's because they're now thinking about stronger economy, stronger labor market, and these were, after all, intended to be emergency temporary benefits.
What would a 3-month extension cost, or what would an extension of any length cost? I guess it depends on the length of the extension.
Full-year extension would cost $25 billion, and that's a lot of money, not in the context of the federal budget, but in the context of what it would take to get this done politically. Remember, we just had the 2 parties agree on a budget deal that lifted the budget sequester by $63 billion. it replaced those cuts. It was very difficult to find that money in ways that they could get Democrats and Republicans to support it. Doing that for $25 billion for this purpose, very difficult.
You know, what happens to these 1 million or so people? Are they hireable? Do you think that news of this sort that's going to be in all the headlines will make some companies say, you know, let's bring them in?
This is a bad news story, Susie, because a lot of these people have been out of the labor force for a while, and the longer you stay out of the labor force, the longer you're unemployed, the more difficult it is to get back in. So I think that many people are not going to get back into the labor market. Some will, as we do get stronger growth. You know, we had 4% in the last quarter, and we see the unemployment rate beginning to come down. So there will be opportunities, but I don't think everyone's going to be able to take advantage of them.
You know, there are arguments on both sides of the political aisle about extending the benefits. What happens to these people when those benefits dry up? Will they go on to some other form of public assistance, number one? And what is the economic effect of the fact that this money will not be going into these individuals' pockets?
Well, it will be some level of fiscal drag. You know, Democrats are making an economic argument for the extension of the benefits, the recycling of that money throughout the economy, and people who don't have very much money, you put some in their pocket, it tends to circulate very quickly. Yeah. But you know, I think that what we're going to see is that as the economy gets better, people are going to count on some of that demand getting replaced by private sector growth, and I think that's what we're looking at.
Real quickly, do you think this is going to impact the unemployment rate? I mean, right now we're at, what, 7%? Will this make any ripple effect on those numbers?
Well, if you have people, first of all, there's always been a debate among economists about whether longer benefits keep people from looking for work aggressively. Right. So that some of that effect could happen, but you also could have some people, if they get discouraged and drop out of the labor market, that could cause the unemployment rate to go down, but for the wrong reason.
Okay, we'll see. John, thank you so much for coming up from Washington to talk to us.
You bet.
Nice to see you, John. All right, it looks like a large number of high-income households are spending less, especially the new wealthy, those who moved into those higher income brackets after the recession. Hampton Pearson says unlocking that consumer spending power in 2014 could be a key to boosting the economy.
The top 5% of American households now earn more than 22% of the total income, according to the latest census data, fueled by a big jump in what economists call the new rich. Households with incomes from $250,000 to $1 million earned since the end of the recession. They're a mix of older professionals, working married couples, and educated singles living primarily in major urban areas. They're heavily dependent on wages, not accumulated wealth in investment portfolios.
The new rich are the people who actually were able to survive this situation, employed, and be able to build upon the opportunities that most of the rest of the population was sort of left out on.
But the scars from the recession, including witnessing the housing market collapse and seeing their portfolios shrink, makes them reluctant spenders.
There is a sense of everything could disappear overnight. And so even though we've, regained a lot of wealth and see new wealth build, those people who are new to it also know it can be gone overnight. And you can't get rid of that.
This new group, which includes a large number of baby boomers, is focused on saving for retirement and rising health care costs. It's a sharp contrast to the greed is good period in the 80s, when consumption equals status. But their economic power is enormous. The 25 million households with that newfound wealth account for nearly 40% of all consumer spending. Leading market strategists say unlocking more of that spending power could be the key to the next phase of the economic recovery.
$650 billion per annum that this segment can contribute if they were only brought back to the level of spending that they had in 1984.
Those same marketing experts say what people with money to spend really want are more high-value products at low cost and more signs of a stronger economic recovery in 2014. For Nightly Business Report, I'm Hampton Pearson.
And coming up on the program, if you think the tech run is over, our market monitor might beg to differ. He has some tech names he thinks you should own next year. That's next.
General Motors and Toyota both issued recalls overseas today, and that is where we begin tonight's market focus. GM and its Chinese partner issued a 1.5 million car recall, one of the biggest recalls ever in China, the world's largest single auto market. The automaker said certain Buicks and Chevys may have defective fuel pump brackets. This is an especially unwelcome hit for GM, which lost its spot, as the top-selling brand in China to rival Volkswagen earlier this year. Meanwhile, Toyota is recalling 400,000 cars in Saudi Arabia because of concerns about unintended acceleration in some Toyota and Lexus models. Let's take a look at the stocks. GM off about 1.5% to $40.94. Shares of Toyota, meanwhile, rose a fraction to 121.88. Textron, the maker of Cessna planes, will buy Beechcraft in a $1.4 billion deal. Beechcraft exited bankruptcy earlier this year under the control of several hedge funds. The deal to combine the two small plane makers is an effort by Textron to counter its slump in jet sales. Shares of Textron up 1% on the news to $36.61.
Shares of ANI Pharmaceuticals surged today on news that the drug maker bought the rights to 31 generic drugs from Teva Pharmaceuticals. Teva will collect $12.5 million on the deal, plus a percentage of future sales. ANI stock popped on the news, up 16% to $19.89. And Baidu was a top gainer in the NASDAQ 100 index today. The Chinese internet giant said it'll pay about $32 million for a reading website from online game operator Perfect World. The news excited investors about the potential for the new unit, which could help expand Baidu's consumer business. Shares rose almost 4% to $173.77.
Our market monitor tonight is looking for a 7% gain in stocks next year at best, but he says you can do better if you fully embrace the idea that 2014 will be a stock picker's market. He's Kevin Caron, a portfolio manager at Stifel Private Client Group, and he joins us tonight by phone. Kevin, welcome and Happy New Year to you.
Happy New Year to you, too.
Our chief economics correspondent, Steve Leisman, says that 2014 is likely to be a year of synchronized global growth that bodes well for the markets. In other words, the U.S., Europe, Japan, and maybe even emerging markets will grow. Do you think that's one of the key follow-throughs for 2014?
Well, I do think so. I think the world is accelerating. We saw growth in the United States reach 4% in the third quarter. We're seeing growth starting to lift around the world, Europe in particular. We're seeing less budgetary drag coming out of Washington, D.C., less uncertainty. Consumers feel better, profits are strong, and the stock market has enjoyed its best run this year since 1997. So we do have some very good momentum going into 2014, and stock market is certainly reflecting that.
And you say, though, even in that positive environment, you have to be very selective on which stocks you do buy. And you have a couple of tech stocks to tell us about. Let's start with Cisco, which at $22 has had a pretty bumpy year, looking at this chart here.
Yeah, so Cisco, obviously the networking giant, is a stock that has lagged this year. It's lagged by about 10% the overall market this year. And one of the big nagging concerns with Cisco has been emerging markets. They were slow. There was a big drag out of China, but I think that fades over time. So I think ultimately what's going to drive Cisco is the rapid rise in bandwidth. That's going to continue. More video, more mobility, more collaboration. You can buy the stock at a discount, 13 times earnings. 3% yield, big boost in that dividend last year. I think you can earn 17% in the stock.
Well, let's spend a few seconds on Oracle, another of your picks, Kevin.
Yeah, this is a very big company, mission-critical enterprise solutions. The company has very aggressively embraced cloud computing. They are going out and making some very significant investments in that space. I think the stock may have gotten a little bit ahead of itself. I would like it to buy it on a pullback. But they are going to be with us for quite a long time, $13 billion in net cash. They're doing that much every year in free cash flow, so it's going to be with us. And their very large installed base of customers means stability for the company going forward.
Kevin, tell us quickly why you like IBM.
Well, again, China has been weak. That has put pressure on the stock. Revenues have been under pressure. The stock is trading about 185. I think it goes to 220. We like it here at Stifel. We think a 21% rate of return is about right when you include the dividend. Again, the near-term issues relating to weakness in business spending, I think, go away as 2014 carries on. China becomes less of a drag. And Warren Buffett likes the stock, 12 times earnings. I think that's a very good company with
Buffett's
a very good
endorsement is second only to yours, Kevin. Thanks very much. Kevin Karan, have a great New Year. We appreciate you being with us. Do you have any disclosures on those stocks? You own any of them or in your portfolios?
I don't own them personally. Stifel is looks to do investment banking with all companies out there. We make markets in these stocks.
All right, Kevin, thanks very much. Happy New Year. He's portfolio manager at Stifel Private Client Group.
Now, despite the current cold weather drawdowns, the U.S. is virtually floating in its own energy supplies. So it may not be a total surprise that the financial community has found a new way to invest in energy. And Congress has made it even more attractive. Morgan Brennan explains.
There's an energy boom sweeping America, and that's good news for investors because Congress created a special tax-advantaged way to invest in energy, master limited partnerships. Better known as MLPs, these publicly traded partnerships pay no corporate tax and distribute most of their profits to shareholders in the form of dividends, kind of like another popular security, the Real Estate Investment Trust. Experts say the dramatic rise in domestic energy supplies has led to a wave of new MLPs that's not likely to stop anytime soon.
Last year, the EIA thought that we'd see a small increase in U.S. crude production, and actually what happened was it was a huge increase, and we're averaging right now around 8 million barrels a day. So the technology is there, and it's only getting better. So I think this coming year, we're going to see even more production from crude, and that's going to help MLPs.
In 2009, there were only 66 MLPs worth a combined $160 billion. Today, there are more than 150 companies worth over $500 billion. In fact, 2013 has been a busy year, with 20 MLPs going public, and cash-hungry investors have welcomed them. One index shows MLPs have outperformed the S&P 500 over the last 5 years by a wide margin. And since MLPs are key sources of financing for energy companies to keep growing, more will debut in 2014. Still, next year could prove challenging for these securities. Much like real estate investment trusts, master limited partnerships are exposed to rising rates, a scenario already beginning to play out as the Federal Reserve scales back its bond buying stimulus program. And there's growing concern that MLPs are increasingly being used to shelter a more volatile range of assets, like coal producers, shipping companies, in one odd case, even a cemetery operator. Even so, high dividends and the country's swelling energy production outlook continue to drum up interest, including from retail investors, since shares can be purchased on the stock exchange like other public companies. A number of analysts suggest sticking to the established large-cap partnerships that own more stable energy-related assets, like oil and gas pipelines, and already pay sizable dividends. It's a lower-risk approach to one of Wall Street's fastest-growing investment offerings. For Nightly Business Report, I'm Morgan Brennan.
And still ahead, we profile the man making a difference by trying to clean up Wall Street. That's coming up next.
Well, we know Americans love their big SUVs, but Autotrader.com says even bigger is apparently better, calling 2013 the year of the full-size truck. Nearly half of the top 20 most popular new vehicles on the site were trucks. In third place was Chrysler Group's Ram 1500 truck. Number 2 was the Jeep Wrangler, and the most popular of all, the great venerable Ford F-150.
And finally tonight, as 2013 comes to a close, we're looking at the difference makers in business this year. And when it comes to regulation, no one has made more of a difference than the top federal prosecutor in New York. We're talking about Preet Bharara. Now in his 5th year in the job, he's showing no signs of letting up. Scott Cohn reports.
Good afternoon, everyone. My name is Preet Bharara, and I'm the United States
When the
Attorney for
U.S.
Southern
Attorney
District of New York.
speaks,
today, we announce 3 law enforcement actions.
the financial world listens. Preet Bharara is the de facto sheriff of Wall Street. And in 2013, he's been busy tackling shady transactions,
The largest international money laundering case,
dubious deals,
misrepresentations about income,
and insider trading.
The scope of illegal trading was deep and it was wide.
Preet Bharara's crackdown on insider trading has completely changed the way information flows on Wall Street. In that critical phone call, there's no telling anymore whether a federal agent is listening in.
Bring it on, baby.
77 people convicted since 2009, and in 2013 the probe peaked with the guilty plea of SAC Capital, the hedge fund's billionaire owner Stephen Cohen, still in the government's sights.
There is no immunity or protection for any individuals.
Barrara's not just fighting insider trading. He charged 2 J.P. Morgan traders with hiding losses at the nation's largest bank. And he's part of a nationwide task force investigating the financial crisis.
We are as aggressive, I think, as any prosecutor's office in the country.
But some say not aggressive enough. In a stinging opinion piece for the New York Review of Books, U.S. District Judge Jed Rakoff says the failure to prosecute individuals involved in the crisis could be one of the most egregious failures of the criminal justice system in many years. Barrara's office declined to comment, but former prosecutor Reed Brodsky, who left for private practice this year, says the lack of Wall Street perp walks is not for lack of trying.
If there's fraud out there, federal prosecutors want to find it.
Besides, Barrara says he's not through with Wall Street yet.
I don't think anyone is too big to indict. No one is too big to jail.
Maybe a signal he's out to make even more of a difference in the new year. Scott Cohn, Nightly Business Report, New York.
And that's Nightly Business Report for tonight. I'm Tyler Mathisen. Thanks for watching.
And I'm Susie Garob. Have a great evening, everyone, and we'll see you on Monday.
Nightly Business Report has been brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garob with a Nightly Business Report news brief. Target is now confirming that the debit card PIN data was stolen in the massive security breach affecting 40 million customers that began last month. But the retailer says the PIN information is, quote, safe and secure because it's encrypted. On Wall Street today, stocks ended the day in the red, but were up for the week. The Dow lost 1 point, the Nasdaq down 10, and the S&P off a fraction. The yield on the benchmark 10-year Treasury topped 3%. It's the first time in 2 years that Treasury yields reached that psychological level. And an estimated 1.3 million people who've been out of work longer than 6 months will lose their federal unemployment benefits tomorrow. Be sure to tune into Nightly Business Report right here on your public television station.